Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to the session 4 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for our 4th session, Building Your Wealth with Wise Investing. Alright, so now let's get started with our session and learn how one can build wealth with wise investing. Many of us endeavor to create wealth for ourselves and give the best to our family. Through experience, we can say that when everyone wants to make a fast buck, many people often indulge in rampant trading without recognizing the risks, which we think can be hazardous to their wealth and health. You may then wonder how one can create wealth. Well, as it is said, Rome wasn't built in a day. It takes a long time and prudence to create something blissful. While all of us desire to become wealthy by the day, it is important to take note that wealth creation is a journey involving process and prudence. You see, in order to create wealth, you need to put your money to use, and you can do this by investing, and more importantly, investing wisely, taking into account a host of aspects which we shall learn in our today's learning session. Remember, even if investing does not seem exciting, it should be taken seriously. Now let's get a little serious and learn the various facets that you need to take into account in the journey of wealth creation with wise investing. Wise investing refers to a systematic process and a prudence-driven approach. Unlike investing in an ad hoc manner where you put your money to use but without much planning involved, it is not about timing the market and feeling the excitement. One cannot always get the market timing right. People who do get aroused by excitement of timing the markets to make quick bucks have higher chances of getting on the wrong foot. Wise investing is about disciplined investing. It allows you to sleep better at night and not worry about whether you have timed the market well to make a quick buck. You see, in order to invest wisely and create wealth, a host of facets need to be taken into account, such as investable surplus, investment objective, risk appetite and risk tolerance, asset allocation, diversification, inflation, cost of investing, tracking and reviewing investments, and selecting an unbiased advisor. First, let's understand investable surplus. It refers to the amount of money which you are left with after having defrayed for all expenses and liabilities, and also after having kept aside some money as contingency fund to take care of rainy days. You see, it is imperative to take a good look at your finances to elevate your investable surplus. Ideally, invest your money first and spend what you have left. This is a much better approach than doing things the other way round. But often people indulge in impulsive buying and then have very little money to invest for it to grow. Think about it. The next thing which you should look into for building your wealth with wise investing is investment objective. Investment objective refers to the purpose for which one is investing. While we all desire to create wealth, we also have to recognize whether preserving capital is also one of the objectives. So can we say setting an investment objective simply means ascertaining why you would like to invest? Knowing the investment objective also helps in planning for your financial goals, which could be buying a dream home, a car, traveling abroad for leisure, children's education needs, their marriage, and even one's retirement needs. But through experience, we can say that very often investors stumble while defining investment objectives. This in turn brings in turbulence in their journey of wealth creation. Knowing your investment objective also helps you to choose suitable investment instruments for your portfolio. With a clear investment objective, you can identify the investment instruments that are suitable for you and add them to your investment portfolio. Then the next is risk appetite and risk tolerance. Risk appetite refers to one's willingness to take risks, depending upon one's age, past experiences, and knowledge. Risk tolerance, on the other hand, implies the ability to actually take the risk, which is measured by one's income. This is an important determinant to gauge risk tolerance. So if your income is high enough, you will not mind taking higher risk while making investment decisions. Likewise, it is also important to know your expenses. You see, your outgoings also influence the risk which you can afford to take while investing. You may have a high income, but if your disposable income is petite, you could be refrained from taking high risk. Hence, it is imperative for you to streamline unnecessary expenses so as to keep your financial health in the pink. Likewise, financial responsibility you're shouldering also determines your risk tolerance, where you take into account the number of dependents and whether your life goals such as children's education and marriage needs are to be planned for. The next is nearness to financial goals. You see, if you have planned for a financial goal, the time left to achieve your goals also determines the risk that you can prudently afford to take while investing. So if you are adequately away in terms of years from meeting your financial goals, you can afford to expose your portfolio to higher risk, which might enable you to create more wealth in the long term. But if your financial goal is drawing nearer, it would be more prudent for you to be a risk-averse investor to preclude wealth erosion. Then whether your contingency fund has been built or not also determines your risk tolerance, meaning have you already saved for a rainy day that can enable you to take risk. Also whether you have sufficient insurance cover. But mind you, while taking care of your insurance needs, it is imperative to separate your insurance needs from investment needs, because buying an insurance cover is for indemnifying risk and not for investment purpose. While buying an insurance cover, you can look for a term plan. In order to build wealth wisely, following the right asset allocation should not be missed. Asset allocation essentially refers to investing your hard-earned money in different asset classes such as equity, debt, gold, and real estate prudently, which can enable you to balance your portfolio's risk and reward, keeping in mind. An asset allocation should be based on risk appetite and risk tolerance, financial goals, and investment horizon. Likewise, diversification is important too. Diversification refers to spreading your investments in different baskets comprising of various asset classes and investment instruments. It is one of the basic tenets of investing. Diversification helps to reduce the risk to your investment portfolio, and therefore most investment advisors harp on this word. But diversification needs to be done wisely by diversifying across asset classes such as equity, debt, gold, and real estate, since all asset classes do not move in the same direction. Diversifying across investment avenues is also important. Thus, say while your risk appetite allows you to invest in equities, you need to diversify well between stocks and mutual funds. Moreover, within stocks and mutual funds, there needs to be an optimal diversification to help you reduce risk as well as create wealth over a period of time. Then diversifying across issuer of securities is also vital. You see, while you are building your wealth, it is vital to diversify across issuer of securities, or else you will be provoking risk concentration to occur. There is no point favoring only one particular issuer, as it could be elevation of risk in your investment portfolio. It is important to keep emotions at bay and invest rationally. Now you can also diversify across countries. Yes, today with resident Indians being permitted to invest in asset classes and securities abroad, your scope for diversification has further widened. but it is important for you to be cognizant about the global economic scenario as well, and specifically the country where you are deploying your hard-earned money. The next to be taken into consideration for building your wealth with wise investing is inflation. Inflation refers to the rising cost of living. You see, as money tends to lose its value over time due to inflation, which eats into our hard-earned savings, you can counter the inflation bug and maintain the purchasing power for your future by investing wisely. Investments should always yield positive inflation-adjusted returns, which in technical terms is also known as the real rate of return that you earn on your investments, and they are calculated as rate of return on investments minus the rate of inflation. The next to be taken into account for building your wealth with wise investing is cost of investing. Cost of investing refers to expenses associated with investing and holding the investments in your portfolio, which could be in the form of fees, loads, demat account charges, bank locker charges in case you are investing in physical gold, or any hidden charges levied by the issuer of respective investment instruments. Remember, your cost of investing should always be low. This will enable you to earn a better rate of return on your portfolio and prevent blunders like getting into high-cost products. Tracking and reviewing investments. Yes, this is indeed needed for building your wealth with wise investing. Tracking investments refers to monitoring your investments regularly. The frequency could be once a quarter and need not be done every day if you have adopted prudence while investing. Reviewing refers to going a step forward and taking an action to make changes to investments held by you. With regular monitoring and review of your portfolio, you can timely know if and where you are going wrong, and if there is a need to take a call to action. You can timely take corrective measures in case any of your investments are going off track. The next is selecting an unbiased advisor. An unbiased investment advisor can contribute immensely to your journey of wealth creation. Focus on knowing his attitude and rationalization. You see, if your investment advisor is focusing on promoting products that earn him high commissions and has not assessed the facets which we have just discussed with you, you could be in wrong hands. He should be transparent and advise you with enough care and prudence as he would adopt while handling his own finances. Know his educational qualifications. Ascertain whether your investment advisor has the requisite certifications from bona fide institutions. But merely relying on certifications too isn't enough, as one needs to delve a little deeper into the philosophy, attitude and rationalization and research process which he adopts while advising his clients. Judge his infrastructure and value-added services. This will help you to gauge whether your investment advisor will be able to serve you better in the future. So what's the role of discipline in wise investing? You see, discipline plays a very important role in wise investing. It has got a very important role. Discipline in investment is vital in wise investing. You should inculcate discipline in your investing. Adding discipline helps you invest regularly and may not let you deviate from your objective. Systematic investment plans can work for you. SIPs offered by mutual funds help you to invest regularly. Systematic investment plans enforce a disciplined approach towards investing, which is indeed needed in the journey of wealth creation. It also aids in maintaining regularity in investing, which is indeed needed to aid compounding of invested amount. Disciplined investment via SIPs offer the following benefits. First, they are light on your wallet, as it allows you to invest in small specified denominations regularly instead of lump sum investing, which some might find heavy. Makes market timing irrelevant. In fact, it helps you to manage the integral volatility of the markets better. You see, timing the markets, apart from requiring full-time attention, also requires expertise in understanding economic cycles and market scenarios, which you may or may not possess. Power of compounding is another benefit which is offered by SIPs. Since SIPs facilitate regular investing, it enables you to invest money to compound well at a set rate of return. The next advantage of SIPs is rupee cost averaging, meaning it allows you to buy more units when prices are low and similarly buy fewer units when prices are high. This infuses good discipline since it forces you to commit cash at market lows when other investors around you may be wary and exiting the market. It also enables you to lower the average cost of your investments. The longer you choose the SIP tenure, the better it is. Take a look at the chart here. Value of monthly SIP of rupees 1000, how it has grown over time frames of 5 year, 10 year, 15 years and 20 years, and the amount of wealth they have created for you. Preferably start early because an early bird always gets a bigger pie. Here take an example which we have learnt earlier in our first session as well. Here Vijay, Ajay and Sanjay want to retire at the age of 60 years. Vijay, being the smarter of the lot, started planning for his retirement at the very young age of 25 years and invested rupees 7,000 per month. Ajay realized the importance of planning for retirement once he was 30, while Sanjay started investing only when he was 35. And you see what they have accumulated when they were on the verge of retirement. So here are some investment mistakes which you should clearly avoid. First, investing without a plan. Remember, wise investing is beyond a 3-step process of getting hold of an investment agent, filling up an application form and signing in a check. Investing without a plan or an investment objective can be hazardous to your wealth. And mind you, segregating your financial goals into short-term, medium-term and long-term will help you to invest in a systematic way. The next which you should avoid is not diversifying well. If you disregard this very basic tenet of investing, you could be in for trouble as you are inviting more risk to your investment portfolio. While you may do well during a run-up of a specific asset class, your portfolio may get battered during turbulence and downturn of the markets. Therefore, it is vital that you don't put all your eggs in one basket. The third is ignoring related risks. You see, simply investing in an ad hoc manner because the investment instruments are fetching higher returns or because your friends and families recommend is not a prudent approach. It is imperative to recognize the risk which respective investment instruments carry and assess them in context to your risk appetite and risk tolerance. The next is getting married to your investments. This is a very common mistake which many people make. It is vital to be objective and review your portfolio at regular intervals to take corrective actions whenever required. Emotional attachment sometimes may not be good for your financial health. The next is timing the markets. While timing the markets is a mantra chanted by many and may sound exciting, it may not always create wealth for you. Remember, a trader is only good until his last trade, as you don't know what the future has in store for you, good, bad or ugly. Let us apprise you that trading and timing the markets can be hazardous to your wealth as well as your health. So to end our today's learning session, some key takeaway points. First, do not rush with investing. Undertake thoughtful research by doing a holistic study. Investing is a serious business. In fact, it may seem boring and not exciting. Have an investment objective in place. This will help you clearly define what you expect and thus identify the appropriate investment avenues. Know your risk appetite and risk tolerance and then invest in suitable investment avenues. Stick to your asset allocation and timely rebalance if required. Do not speculate or time the markets. Trading and timing the markets can be hazardous to your wealth as well as health. The next is never use contingency funds to invest. Remember, they are put aside as a part of your savings to take care during emergencies. Do not rule out inflation factor while investing. After all, the rate of return you earn on your investments has to outpace the inflation bug. Never invest with borrowed funds except in cases of investing in real estate and business. But again, while investing therein, don't go overboard or beyond your means. Know your investment product well, understand how it works and undertake research. Recognize the risk-reward relationship the product offers and also the tax implications thereof. Select an unbiased advisor whom you can trust while investing your money. Diversify well. Remember, this can help you to reduce your risk to your overall investments if you diversify wisely. And last but not the least, track and review your investments so as to take corrective measures wherever required. So to end our today's learning session, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.